Have you ever noticed how every economist and politician tells you to spend more money? Stimulus checks, tax rebates, consumer spending drives the economy, shop to support your country. But when you try to save money, suddenly you're hurting the economy, being unpatriotic, causing recessions. Here's what nobody tells you. Governments actually benefit when you spend and suffer when you save, and they've built an entire system designed to make saving as unappealing as possible. This isn't a conspiracy theory, it's basic economics. But it's economics that work against your personal interest. Here at Simple Money, we've spent years analyzing how government policy impacts individual wealth. Not what politicians say, what the actual incentives and mechanisms do. Today, I'm going to reveal exactly why governments hate when you save money, how they punish savers through policy, and what you need to understand to protect your wealth anyway. Because once you see this system clearly, you can't unsee it. Let's start with what you've been told about saving money. Saving is responsible, prudent, the foundation of financial security. Your parents told you to save, financial advisors tell you to save. It's common sense. And for you personally, saving is absolutely essential. You need an emergency fund, retirement savings, a down payment fund, security. But here's what's really happening. What's good for you as an individual is often bad for the government, and what's bad for the government gets discouraged through policy. Think about it this way. Imagine you run a shopping mall. Your profit comes from people buying things in your stores. Would you want shoppers who walk through, browse, and leave without buying, or shoppers who spend everything they have? Obviously, you want spenders. Savers are useless to you. They generate no revenue. Governments operate with similar incentives. They benefit when money moves through the economy, when people spend, when businesses make sales, when transactions happen, because that's when taxes get collected. Sales tax, income tax, corporate tax, capital gains tax. When you save money, it's not circulating, not generating tax revenue, not creating economic activity that politicians can brag about. You're taking money out of the game, and governments hate that. But it gets worse. Governments don't just prefer spending over saving. They've actively built systems that punish savers and reward spenders. And most people never realize it's happening. Let me introduce you to the first way governments punish savers. I call it the inflation tax, and it's the most insidious because it's invisible. Here's how it works. When you save money in cash or in a savings account, that money slowly loses purchasing power. Because of inflation, inflation means prices go up over time. The same dollar buys less stuff than it did last year. This feels natural, like it's just how the world works. But here's what they don't tell you. Inflation is a policy choice. Governments and central banks deliberately create inflation, usually targeting about 2% per year. Why? Because inflation benefits borrowers and punishes savers. And guess who the biggest borrower in any country is? The government. Let me give you concrete numbers. You have $10,000 in a savings account. Inflation runs at 3% per year. Your bank pays you 0.5% interest. After 1 year, you have $10,050, but prices have gone up by 3%. So your money can now buy what $9,700 could buy last year. You lost $250 in purchasing power. That's the inflation tax. And you never saw a bill, never got a notice. It just silently eroded your savings. Now multiply this across millions of savers in decades. The government is essentially taxing your savings at 2 to 3% per year through inflation. Meanwhile, the government benefits. It borrowed trillions of dollars years ago. As inflation happens, that debt becomes cheaper to repay in real terms. They borrowed when dollars were worth more. They repay when dollars are worth less. Inflation is a gift to them. Here's a specific example. The US government borrowed $1 trillion in 2010. With 3% annual inflation, that debt is worth only about $700 billion in real terms today. The government effectively got a $300 billion discount just by waiting and letting inflation do its work. That $300 billion came from savers. From you, the psychology here is cruel. You did the responsible thing. You saved money, but the system is designed to slowly confiscate it through inflation. And when you complain about rising prices, politicians blame corporations or supply chains. They never mention that their deliberate inflation policy is the root cause. The inflation tax is why putting cash under your mattress is financial suicide. But even in savings accounts, you're losing ground when inflation exceeds interest rates, which is almost always. Now, this next one is particularly obvious once you see it, but most people never connect the dots. It's what I call the spending incentive machine, and governments have built it into every corner of the economy. Governments constantly create policies that encourage spending and discourage saving, tax deductions, stimulus payments, low interest rates, easy credit. Let me break down some specific examples. Mortgage interest is tax deductible in many countries. You borrow hundreds of thousands to buy a house, and the government gives you a tax break. But if you save that money instead, no tax break. In fact, any interest you earn gets taxed as income. The system rewards you for going into debt and punishes you for saving. That's not an accident. That's by design. Here's another example. During economic slowdowns, governments send stimulus checks, free money to encourage spending. The stated goal is always to get people to spend, to stimulate demand, to boost the economy. They're literally paying you to not save. And what about interest rates? Central banks deliberately keep interest rates low, often lower than inflation. This makes saving pointless and borrowing attractive. If you can borrow at 2% and inflation is 3%, you're being paid to borrow. The debt gets cheaper over time in real terms, but if you save at 1% while inflation is 3%, you're losing 2% per year. You're being punished for saving. Think about what this does to incentives. A responsible person wants to save up and buy a car with cash, but interest rates are so low that saving barely grows the money. Meanwhile, the car dealership offers 0% financing. You'd be stupid to pay cash. The system pushes you toward debt. This is the spending incentive machine. Every policy is designed to make spending feel smart and saving feel dumb. Here's why governments do this. Their entire economic model depends on growth, and growth comes from spending. Consumer spending is 60 to 70% of GDP in most developed economies. If everyone started saving aggressively, spending would collapse, GDP would shrink, tax revenues would fall, politicians would lose elections. So they manipulate the system to keep money moving. Keep people spending, keep the machine running. Your personal financial security, that's not their concern. They need you to be a good little consumer. Spend your paycheck, take on debt, keep the economy humming. The spending incentive machine ensures that saving is always swimming upstream, possible but working against the current. The third reason governments hate saving is what I call the velocity obsession. Velocity means how fast money moves through the economy. The more times each dollar changes hands, the more economic activity occurs. More transactions, more taxes, more GDP. When you save money, you reduce velocity. That money sits in an account instead of circulating. From the government's perspective, that's a problem. Let me explain with a concrete scenario. You earn $100. You could spend it at a restaurant. The restaurant uses that money to pay its employees. The employees spend it at stores. The stores pay their suppliers. That $100 created $400 in economic activity, 4 transactions, 4 opportunities for the government to collect sales tax. GDP goes up. Now imagine you save that $100 instead. It sits in your account. 0 additional transactions, 0 additional tax revenue, 0 GDP contribution. The government sees your savings as dead money, economically useless, and they want it moving. This is why governments panic during recessions when savings rates spike. People get scared, they stop spending, they save more. From an individual perspective, this is smart. Build a cushion, prepare for hard times, protect yourself. But from a government perspective, this is a disaster. It's called the paradox of thrift. When everyone saves at once, spending collapses, the economy shrinks. So what do governments do? They try to force money back into circulation. Stimulus spending, interest rate cuts, anything to prevent people from saving. During COVID, many countries sent direct payments to citizens. The goal was explicit: get people to spend, keep velocity high, don't let money sit idle. Here's a specific example. In 2020, Americans saved a record percentage of their income. They were scared, uncertain. They hoarded cash. The government responded with massive stimulus, trillions in spending, near zero interest rates, encouraging people to spend, borrow, invest, anything but save in cash. Why? Because high savings rates mean low velocity, and low velocity means shrinking GDP and lower tax revenue. The psychology governments exploit here is interesting. They frame saving as selfish, unpatriotic, hurting your neighbors who need you to spend at their businesses. They make you feel guilty for being financially responsible, for protecting yourself, for doing what's obviously in your personal best interest. The velocity obsession means governments need you to spend constantly. Your savings are their enemy, and they'll use every tool available to get that money moving again. Here's the fourth way governments discourage saving, and this one might make you angry. I call it the debt dependency system, and it reveals a dark truth about modern economics. Governments don't just prefer spending over saving. They've built entire economies dependent on people carrying debt: consumer debt, mortgage debt, student debt, credit card debt. Why? Because debt creates predictable, ongoing consumption. When you have debt, you must work and spend to service it. You're locked into the system. Someone with no debt and high savings, they have options. They can quit their job, move, take risks. They're not dependent on the system. But someone with $50,000 in student loans, a mortgage, and credit card balances, they're trapped. They need steady income. They need to keep consuming to maintain their lifestyle. From a government perspective, debt makes citizens predictable, controllable, dependent on economic stability. Let me give you a specific example of how this works. Government-backed student loans. Governments guarantee these loans, making them easy to get. This seems helpful on the surface. Education, opportunity for everyone. But look at the effect. Millions of people start their adult lives with tens of thousands in debt. They must work for decades to pay it off. They can't take time off, can't pursue lower-paying passions. They're locked into high-income careers to service the debt. The government now has a population of highly educated, productive workers who can't afford to stop participating in the economy. Perfect. Here's another example: mortgage tax deductions and low down payment programs. Governments make it easy to take on huge debts to buy homes. 30-year mortgages, hundreds of thousands in debt, monthly payments that must be made or you lose everything. Again, this creates dependency. Homeowners with mortgages can't just stop working, can't easily relocate. They're tied to the system. Compare this to someone who saved aggressively and bought a modest home with cash, no mortgage, low expenses, complete freedom. That person doesn't need the economy to be stable, doesn't need their job as desperately, isn't forced to consume constantly. The government gets less from them. Less tax revenue, less predictable behavior, less control. The debt dependency system ensures that most people are always working, always consuming, always needing the system to function. And saving money is the enemy of this system, because savings create independence. Options: freedom. Governments prefer you leveraged and dependent. It's easier to govern, easier to predict, easier to extract tax revenue from. The uncomfortable truth: modern economic policy isn't designed to help you build wealth. It's designed to keep you productive and consuming. Saving money is a form of rebellion against this system. That's why it's so actively discouraged. The fifth and final way governments punish savers is what I call the financial repression game. Financial repression is a term economists use for policies that force savers to accept below-market returns, basically rigging the system against people trying to save. Here's how it works. Governments keep interest rates artificially low, lower than inflation, lower than they would be in a free market. This forces savers into an impossible choice: accept negative real returns on safe savings or take more risk in stocks and other investments. Let me break this down with specific numbers. Inflation is running at 4%. The government keeps interest rates at 1% through central bank policy. Your savings account pays you 1%. You're losing 3% per year in purchasing power. Guaranteed loss. To avoid this loss, you must put money into riskier investments. Stocks, real estate, corporate bonds, anything that might keep pace with inflation. But now you're taking risk. Risk you might not want or be comfortable with. Risk that could result in losses. The government has effectively forced you out of safe savings and into risk assets. That's financial repression. Why do they do this? Two reasons. First, low interest rates make government borrowing cheaper. When rates are low, the interest on the national debt is manageable. Second, pushing people into risk assets inflates those asset prices. Rising stock markets and real estate make people feel wealthier. This encourages spending. Here's a concrete example. A retiree has $500,000 saved. In a normal interest rate environment, they could get 4 to 5% safely. That's $20,000 to $25,000 per year in income, enough to live modestly without touching the principal. But with financial repression, safe rates are 1%. That's only $5,000 per year, not enough to live on. The retiree is forced to either invest in riskier assets or slowly deplete their savings. Either way, they're worse off. The government benefits. Low rates keep debt payments down. Inflated asset prices make GDP look good. Tax revenue from capital gains increases, but savers get crushed. Especially older savers who can't afford to take risks. They worked their whole lives, saved responsibly, and now the system is rigged against them. The psychology here is insidious. The government makes safe saving impossible, then blames you for not taking enough risk or not having saved more. They create the problem, then shame you for falling victim to it. The financial repression game has been running since 2008. Interest rates have been held artificially low for over 15 years in most developed countries. An entire generation of savers has been punished. Trillions in potential interest income has been transferred from savers to borrowers and governments, and this isn't ending anytime soon, because ending it would mean higher government borrowing costs. Politicians won't allow that. Now, let me blow your mind for a second. Everything I've just explained, these 5 ways governments discourage saving, they're all connected. They're not separate policies. They're a coherent system. Inflation erodes savings. Spending incentives make debt attractive. Velocity obsession requires constant consumption. Debt dependency locks people in. Financial repression eliminates safe returns. Each piece reinforces the others. Together, they create an environment where saving is nearly impossible and spending is the only rational choice. But here's what nobody wants to admit. This system isn't sustainable. It requires perpetual growth, ever-increasing consumption, constantly rising debt levels. What happens when people are tapped out, when they can't borrow more, when they must save to survive? The system breaks. We saw glimpses of this in 2008. In 2020, each time, governments responded with more of the same policies, more stimulus, lower rates, more inflation. They're addicted to growth through consumption, and they'll sacrifice your savings to maintain it. Think about the generational impact. Your grandparents could put money in a savings account and earn 5%, real returns above inflation. Building wealth safely was possible. Your parents had lower returns, but still positive real rates in many years. Saving wasn't lucrative, but it worked. Your generation, negative real returns for 15 years and counting. Saving is wealth destruction. You're forced into speculation or debt just to keep pace. This isn't normal. This isn't how healthy economies work. This is a system on life support. And your savings are the blood transfusion keeping it alive. The uncomfortable truth? Governments need you to be a spender and a debtor, not a saver, not financially independent, because savers are unpredictable. They have options. They don't need stimulus. They don't boost GDP through consumption. The entire modern economic model is built on people living paycheck to paycheck, borrowing, spending, dependent on the system. Saving breaks that model. That's why governments hate it. That's why every policy pushes against it. Let me tell you about Linda. She's a teacher, makes $55,000 per year, believes in doing the right thing financially. Linda has been trying to save for retirement. She read all the advice. She opened a savings account at her bank, started putting away $500 per month. Over 5 years, she saved $30,000. She's proud of this. It represents real sacrifice, skipped vacations, drove an old car, packed lunches. But here's what Linda didn't realize. Her savings account pays 0.3% interest. Inflation has been averaging 3.5% over those 5 years. Linda earned about $450 total in interest over 5 years. But inflation ate away over $5,000 in purchasing power. Her $30,000 can now buy what about $25,000 could have bought when she started saving. She lost $5,000 just by being responsible. Meanwhile, her friend borrowed money at low rates to invest in real estate. That friend's net worth grew significantly despite having debt. Linda did everything she was told to do: save in a safe account, don't take risks, build a cushion, be responsible. But the system punished her for it. The inflation tax destroyed her purchasing power. Financial repression gave her negative real returns. She would have been better off spending the money. Linda represents millions of people who try to save in traditional ways, who follow old advice in a new system, who don't realize the game has changed. She's losing the financial game by playing it the way her parents did. The rules changed, but nobody told her. Now let me tell you about Marcus. Also a teacher. Also makes $55,000 per year. But Marcus understands the system we've been discussing. He knows governments punish cash savers through inflation and low rates. So Marcus took a different approach. He saved the same $500 per month, but instead of a savings account, he invested in a diversified portfolio of index funds. He also bought a home with a low down payment and a 3% mortgage. Yes, he took on debt, but strategic debt at rates below inflation. Over the same 5 years, Marcus's investments grew to about $40,000. The stock market had good years. He captured that growth. His home appreciated in value. His mortgage debt became cheaper in real terms due to inflation. His net worth increased substantially. Marcus has more risk than Linda. Markets could drop. But he understood that in a system designed to punish savers, you must adapt. He didn't just save, he positioned himself to benefit from the same forces that hurt Linda: asset inflation, low borrowing costs, financial repression pushing money into risk assets. The difference between Linda and Marcus: not intelligence, not starting capital, not luck, understanding. Marcus understood that the system punishes traditional saving, so he adapted his strategy to work with the system instead of against it. Linda followed advice from a different era. Marcus followed the actual incentives of the current system. Same income, same savings rate, completely different outcomes. Here's what most people don't realize about government policy towards saving. It's not actually about economics. Not really. Yes, governments benefit from spending and consumption. Yes, the system is designed to encourage that. All true. But here's the deeper issue: control. Savers are independent. They have options. They can make choices based on their values instead of economic necessity. Governments, especially modern interventionist governments, prefer predictable, dependent populations, people who need the system, who can't easily opt out. Saving creates independence. Financial independence is the foundation of all other independence. You can't control someone who doesn't need you. That's the real reason governments discourage saving. Not just for tax revenue, not just for GDP growth, for control. A population of savers can weather economic storms without government help, can make career changes, can retire early, can choose lower paying but more meaningful work. A population of spenders needs constant economic growth, needs stable jobs, needs government intervention during downturns, needs the system to function perfectly. Which population is easier to govern? Which population will accept more regulation, more taxation, more control? The spenders. Always the spenders. Once you see this, everything makes sense. Why student debt is encouraged, why mortgages are subsidized, why savings rates are suppressed. It's not about helping you. It's about creating dependency. The empowering part, once you understand this, you can make informed choices. You can save anyway, but do it strategically. Invest in assets instead of cash. Use leverage wisely. Build multiple income streams. Create independence despite the system working against you. You can't change government policy, but you can adapt to it. You can win the game even when the rules are rigged. So let's bring this all together. The inflation tax. Your savings slowly confiscated through deliberate money printing. The spending incentive machine. Every policy designed to reward debt and punish saving. The velocity obsession. Government's need for money to constantly circulate. The debt dependency system. Creating populations locked into consumption. The financial repression game. Eliminating safe returns to force risk-taking. These aren't accidents. They're features of a system designed to extract maximum economic activity from citizens. The question isn't whether this is fair. It's not. The question is, what are you going to do about it? Are you going to keep saving in ways that guarantee you lose? Are you going to follow advice from an era when the rules were different? Or are you going to adapt? Learn to save in assets instead of cash. Use strategic debt instead of fearing all debt. Build wealth despite the system working against you. Start understanding inflation and positioning accordingly. Learn about investments that keep pace with or exceed inflation. Consider how leverage can work for you instead of against you. The government doesn't want you to save, but that doesn't mean you shouldn't. It means you need to be smarter about how you do it. Because financial independence is still possible. It's just harder. It requires understanding the game and adapting your strategy. Governments hate when you save because saving creates freedom, and freedom is powerful. So save anyway. Just do it strategically, in assets, with understanding, with your eyes open to how the system really works. The question is, will you adapt? Or will you keep losing 3% per year while wondering why saving feels impossible?